And we are now starting our session with Colin Lambert and David Mercer. I'm going to open up their lines, and you can take it away, gentlemen.
Thank you, Ken. David and I were just David just very kindly pointed out that we're actually on time, and this is the first for P&L. And can I say, Mr. Mercer, that's a very astute observation.
Yeah, normally 2 o'clock means 2:30-ish.
This is where I blame the attendees. It's like herding sheep or herding cats into a swimming pool, getting away from all the marvelous exhibits. So anyway, yes, we are back. Thanks for joining us, everybody, and staying with us. I am with David Mercer, CEO of LMAX Group. Our subject matter for today is, does the world look different now? Which I think we can get to. David, somebody's binging, it might be me. David, I mean, the first question on everyone's lips is, how's your pandemic, so to speak? I mean, how have the last couple of months been for LMAX Group, generally speaking? And obviously, you came off some strong numbers at the end of last year. We assume that they're going to be even better. But I mean, so how's this sort of last 2 months been for you guys?
I think the first thing is the personal impact. So I'd like to give my well wishes to everyone out there and everyone's families, and hope that everyone's staying as well as they can. And look, that's been the way we've approached things for the last month. Number one has been the health of LMAX staff and their families. Number two has been wider public health, doing a little bit for the community here. And thirdly, only after those first two are satisfied, we've looked at the business. So look, we're an exchange business. As you'd expect, we did very well with the volatility in March. So Q1 was a record for us, as you say, on the back of 2019. And March, we hit all-time highs. But that's the same, I think, across the industry. As a venue operator, as an exchange, if you don't print in March, then you never will. April, things have come off. People are licking their wounds a little bit. But all in all, on the business side, I couldn't be happier. We've gone from having 11 offices to having 142 offices, which are living rooms and bedrooms. So from the business standpoint, so far so good. I'm operating, a sort of gesture behind me. I'm operating with 7 or 8 people out of 150 in the office on a day-to-day basis. So been able to operate 5 exchanges like that was something we hadn't planned, but we're very pleased it's gone well so far.
I mean, on a personal note, I'll point out that you guys did donate £250,000 to a local charity as well. So good on you on behalf of the industry. I mean, so in terms of looking ahead, does the world look differently now as being our theme? Do you sort of think we are seeing a fundamental shift in working patterns and maybe even the market structure?
Oh, I'll answer them in turn, I guess.
Yep.
Working patterns, almost certainly. I mean, certainly there was this idea that you could trust senior employees, senior staff, to work from home, to work from overseas like yourself. I mean, that's actually how I ended up with an office in Auckland, is that a couple of guys said they were leaving, but they didn't really want to leave the company. They were just going home. So we worked out, as they were technologists, that they could develop software just as well in Auckland as they could in London. So but what's happened is it's filtered down. I mean, we went out probably like the rest of the world in January, February, and bought a whole bunch of laptops. And now even the most junior members of staff or the most recent members of staff are able to work from home. So that's going to change. The trust has filtered down through to everyone. So you're going to ask questions about, do you need the most expensive real estate in Manhattan, in London, in Tokyo, in Singapore? And certainly offering people flexibility will widen your talent pool. That's important, right? I mean, some people don't join me because I happen to be in West London rather than the City of London. And they don't want to do an hour. Look, if you're around in Essex, you don't want an hour and 15 minutes or hour and a half commute either way. So we can change that. That's going to be interesting. In terms of the core business, that said, I think, for young people and for new starters, it's important they understand the culture and it's important they learn from others. That's only going to happen if you have an epicenter. You have some sort of a hub where you can get together at least 2-3 days a week. So look, there'll be fundamental changes. I think they'll be for the better. Maybe the governments can get together and I don't know, do what they do in Paris, for example, so that they cut down or Athens, they cut down on travel and pollution. It's quite nice to see the sky. I saw someone in Los Angeles recently took a picture and said, "Wow, we have mountains." It'd be quite nice if there was some other benefits to this. I think in terms of market structure, I don't know. I mean, I think we've bounced back really quickly to where it was before. I think the market should congratulate itself for the way it held up with the volatility in March. Look, the commodity markets have been a bit different, and these are maybe once in a lifetime, right? So who would have known that they'd pay you to take oil? Who would have known that had the problems of shipping gold around the world? But again, we've dealt with them pretty well. So I'm not seeing any massive change. I guess the one thing I'm seeing I'm currently seeing in April is a real lack of risk appetite at the start of the Asia session. That first hour or two is probably worse than I've seen in a decade in terms of liquidity or appetite to take on risk. It seems to me, we have to wait for the futures market to open up. You have to wait certainly for Singapore and Hong Kong to come in, and there's little or no risk appetite purely from Auckland or Sydney.
Is that kind of then, I mean, it sounds to me like it's kind of exacerbating an existing condition. Is it also the case when you get into the New York afternoon that you're seeing sort of, things struggle as the day progresses there?
Not terribly, if I'm honest with you. I mean, look, yes, we had a low base, but, we're at all-time highs in NY4. Great Q1. It's kind of continued into April. So it's chugged along. I think it's chugged along in April. I'd be surprised if you see the figures in a couple of days' time if everyone's hitting the high notes in April that they did in March. But, I'm not seeing, honestly, at the moment, I'm not seeing anything that systemic. And I think, the great and the good who run banks and some of the larger non-banks around the place will be looking at this and deserving some congratulations for how they've managed to operate so diversely in the past month or two.
I guess the thing that worries me there is, from what you were saying about the Asian hours in particular, is it becomes a bit of a chicken and egg situation. So obviously, I think what you're talking about there is a reflection that there is more automated pricing than ever before.
Yep.
Which maybe is another change from the pandemic. We can discuss that in a second. And I guess, so if they're all taking time out in the early Asia, there's no data, which means, guess what? There's no pricing. It just kind of snowballs up, doesn't it? I mean, is your instinct that you're seeing a lot more liquidity from automated sources?
I think that's been what you'd expect, Colin.
Yeah.
There's more.
Has it sort of maybe exceeded the expectations?
Yeah, sure. I mean, I think first on the positive side, I think pricing has been pretty consistent. After March, it's been wider. It was wider across the board. I mean, you look at some of the spreads, even in euro, in cable, back in the heady days in March, and we haven't seen those in a decade or two. Come back in. There's still a bit of fat built in. I'm not going to tell you we're anywhere close to 2019 or even the start of 2020 yet, but the algos have consistent pricing, albeit with a little bit more juice built in than previously. I'm guessing we do run a risk. If you talk about those Asia hours again, we do run the risk of a few more flash crashes.
Yeah.
In those grey hours, but I mean that hasn't gone away. I mean, ever since the sterling flash crash, I guess that was 2016, and yen at the start of last year, those risks of flash crashes or someone taking the market on in the wee small hours, those risks haven't gone away. And I suspect there'll be more of it when we move more towards a risk-on environment again.
Yeah. Carry on.
No, that's it.
I say, I mean, it's. I think it's I guess the point that I would take from your comment there is, it's smaller orders now run the risk of triggering these moves.
For sure.
Before it had to be more persistent.
For sure. I mean, I'm not seeing. I mean, ask around the market. Ask later in the panels. I'm not seeing any significant what I'd classify as institutional flow in those first few hours of the daily session.
Yeah.
It seems to be broker to broker. It seems to be retail led. So if someone chooses to take it on, there won't be much liquidity there, and I think you could see a few gaps.
Something to consider, isn't it? I mean, in terms of like the sort of move back to something of a status quo, we'll call it something of a status quo. I mean, do you feel that there's perceptions have changed over different liquidity? I mean, obviously, you're a big proponent of firm liquidity, which is what you offer. We've had interesting comments already from panelists around, anonymous versus disclosed channels. Is your sense that there's also sort of conversations or thoughts going on around firm versus non-firm liquidity?
So I'd love to give you a resounding yes, and it's all coming my way. The reality is, and it was ever thus, that's probably what I've been doing for a decade. In times of volatility, you win 6, and then you lose 5. But you keep 1. And then the next time, 6 again, and you add another 1. It's incremental. There's no doubt that we did better than last look venues, comparatively speaking, in Q1 and in March specifically. I mean, when I looked at my competitors, we were up 60% quarter on quarter, Q1 versus Q1 the year before, more than all of them. Don't get me wrong, they all had stellar days. So you think, okay, the tide has turned. The market now wants certainty of execution. They want firm-only liquidity. They want central limit order book liquidity. But ultimately, the algos are still the same. The price, the way they decide which price they decide to hit is still the same. So ultimately, that's price first and foremost. Not about the certainty of execution. Not about fill rates. Not about market impact. So I think it's slowly, every time you have a volatile event, we convert another desk. We convert another customer. But look, I have to be honest and say that in April, it looks to me like we've reverted to the same competition. I just simply I have to convince customers it's always cheaper to trade without last look. And the conversation, the debate is no different. Now I have a better data point. The March is a great and recent data point. So that helps the conversation. But as I said, the decisions are still made the same way in April as they were in February. So you haven't seen this great landslide to firm. But on the prospecting front, I've had more interest this month from bank algo desks that represent buy side, in the real money segment, than I've ever had in the last 18 months. So I think the future will be firm only. There's no doubt about that. It's just a question of when. And I'll let you know in 6 months whether March has precipitated that.
Yeah. So is it therefore then a question of like, you need to make sure that the sort of liquidity on offer, we were speaking earlier on our first session of the day, that, top of book and liquidity, as you've just recognized there, has come back to more normal levels.
Yeah.
And I always struggle to use that phrase in the current environment.
Yeah.
But they're still a little bit fragile. So is it then going to be a question of making sure that the top of book and depth of market in a firm stream is sufficiently robust?
100%. I mean, that's a daily task. And there's no doubt. I mean, I could sit here and tell fairy stories, but the reality is my liquidity providers, and they're a great mix of the world's biggest banks and the world's biggest non-banks. They make firm-only prices and streamed limit orders on LMAX, but they make last look prices elsewhere. And there's no doubt they came back first. They came in first. Last look venues. And what I mean by come back in, they price me throughout, but when they start to tighten up, when they start to think volatility is over, then they can do that on a relatively risk-free basis on last look. So, first of all, I have to get the spread back top of the book, and then we have to get the depth. That said, the good news for us was that depth never went away. That's why we had, stellar days in March. That's why we had an ADV in March of 26 yards, was because we always had the depth. It just wasn't at 0.3, 0.4, 0.5, right? You're talking pips rather than ticks in March. So when they come, when you want to see a price again, look, the last look feed will always tighten up first, but then it's my job to get a mix of liquidity so that firm can compete.
And I guess, the other thing that was mentioned earlier on is like last look times being widened out by certain LPs. That would probably help your case, I guess. If we got to that stage, the challenge is obviously identifying who it is and what's happening. Do you think that there's going to be a different perception around liquidity providers from like liquidity consumers? Do you think that there would be an appreciation for those LPs that didn't lengthen the last look window, that did provide more firm liquidity?
Look, you'd like to think so, right? You'd like to think it's there's some honor out there and people would get payback for standing by you. But ultimately, we're in capital markets.
Yeah.
And, our business goes to where the best price is. And there's little loyalty anywhere in the world now when it comes to a marketplace. Be that in any marketplace online, insurance to books, to equities, to foreign exchange. Ultimately, you're going to seek out the best deal for you at that time. And the consumers are plugged in everywhere. Now, I think if they've been ridiculously penalized, and we saw this after the flash crash. I have some stats in one of our historic white papers where we saw last look providers basically move their window out by 50 millis on the date of the UK referendum, but it never came back.
Yeah.
So you'd expect, look, if I accept the last look price, I'd probably accept an extension of that window for a few days when the market was volatile, but I should expect it to come back again. If it doesn't come back, then I think you're going to see people voting with their feet, because ultimately in this day and age, if you talk last look hold times outside of 10 milliseconds, well, you're just doing yourself, your customers, and all your stakeholders a disservice. It has to come back, and there I think there will be a long-term payback.
Yeah. I guess the challenge is that too many people are going to hide behind best execution policies. So I've got to hit best price. There's no room for loyalty in best X world. Maybe we need to just evolve best X to actually understand that hitting, having a 10-15% reject rate is not acceptable and works with your execution.
To be fair to the regulatory terminology of best execution, it's not just price. There are 5 factors in there. So I think they're all taken in consideration. And people who are obliged, look at the real money segment again, they're obliged to abide by best X. So I think they're constantly reviewing it. And that's where I see more of that flow than I ever did, because frankly, there are 3 sources of streamed limit order liquidity out there today, just 3. I'm one of them. And they're starting to realize that they have to have LMAX exchange pricing in their stack, even if they never hit it, just to say, look, this is the steps we took. And actually, it's 7 steps they must take for 5 factors. These are the 7 steps we took to ensure best X.
Are you seeing any sort of trends around the type of market participant that's been driving the volumes? I mean, like, did it go highly speculative during your very high?
Yeah.
That is the phone in this house. First one today. Did you see the volume spikes in March driven by speculative, real money hedgers? Was there any trends emerge?
Heaps. So I mean, on the broker segment, you saw an awful lot of speculation, I guess, which was driven from their retail investors. I think they had I think those end investors had a poor time ultimately. Hence why it takes a while for those brokerage businesses to bounce back. I think on the making side, you saw the low latency enabled guys, the highly connected guys doing better and coming back again and again for more business. You've seen some of the results, I'm sure, of the listed vehicles. They were making annual profits in a month.
Yeah.
And I think certainly on the a lot of the heavy flow that you saw from bank desks and algo desks were coming from the real money segment. Obviously, we're now in a period, I guess we're in a period of risk off. So there was a shocking lot of trading and volatility driven by those asset managers and pension funds, certainly in the early days in March.
So a question from our audience. I hope you understand this one. Can you explain your ABCs of crypto land?
Yeah. It's as simple as ABC. Let's see if I can remember. Okay. Adoption, banking, and credit. Yeah, people talk about the institutionalization of crypto, and I think a lot of people overcomplicate it. It's as simple as that, right? You need wider adoption in the outside world, so you need to be able to go and buy more stuff with crypto. You need better banking. And the banks who bank crypto today, if you touch Bitcoin, have tiny balance sheets in comparison. We're talking a few $100 million.
Yeah.
A couple of billion is the biggest. So we need better banking there, and we need better credit facilitation. Look, the real money we talk about there in FX land, those funds, those asset managers, they want to trade crypto, but they're not going to face a few $100 million of balance sheet. They just are not. They need the top-ranked banks to enter into the space, to offer them the credit, to offer them the market access, and probably provide them the custody. So yeah, ABC, adoption, banking, and credit.
Do you think, obviously you've got LMAX Digital as part of your group, another one of your exchanges. Do you think that the case for digital currencies will be advanced by the pandemic?
Again, all the theory says yes, but we didn't really see that. Ultimately, we're scratching our heads, if I'm honest with you. Myself and the biggest liquidity providers out there are scratching our heads. We thought this thing would roof, and we thought the risk off from traditional assets would go into crypto. In fact, Bitcoin specifically, got sold off more than every other asset against the dollar in March. It was off 27%. We had that crazy day in the middle of March where it traded as low as 4,000. What I would say is its bounce back ability is phenomenal. The chart looked like the oil price. We looked at it and it was going to 4,000. We said, this could go to zero. And there's no floor. There's no one to intervene. There's no regulatory intervention. There's no central bank intervention. This thing could go to zero. In fact, oil beat it and went to zero and beyond. So I think crypto bounced back just now. It's traded through 8,200. So that's a good sign. But I think what you saw in March was ultimately people who were in crypto or crypto only diversified into other assets. They need to shore up those positions. Maybe they had to meet margin calls. Maybe they wanted to go to cash, just like most of the traditional investors. But now you're starting to see it come back. And I think every crisis that Bitcoin exists through will make it stronger. So it's not, you couldn't say in March that it's a store of value. No way. But I think you could see it rally from here. And that said, there's a bit of correlation to to what everything else is doing against the dollar right now.
Yeah, it's an interesting world now, isn't it? And I guess it's, you kind of touched on it there. The important key element is margin, because, you know, as an old trader, I was always taught, cut your losses and run your profits.
Yeah.
And it seems to me now that when the world has a meltdown, you're making money on Bitcoin, but you've got to sell it, your position out to pay for your others. That's not kind of how it used to work, but, you know, it is what it is. So finally then, I want you to really kind of talk through your plans for LMAX Group over the next year. Maybe sort of with the extra sort of little feature around, like, you know, have these plans been delayed or altered because of the pandemic?
I wouldn't, to be honest, no. But I'd be foolish to say that we won't have an impact. I mean, like the rest of the world who's in a distribution business, we haven't been able to sell for the last 3-4 months. In Asia, we haven't sold for a quarter. We've only just been able to do some sort of face-to-face marketing in the last week in some countries. So there's going to be a payback there. Otherwise, no. I mean, look, at no stage have we requested government help. At no stage have we furloughed staff. I'm at my highest ever headcount. So we plow on regardless. And we're just going to roll with the punches and see what comes up in Q2, Q3. But so far so good. 2020 is better than 2019. We still fight the good fight. We're still trying to convince people of that it's always better to trade without last look. We're still trying to widen and extend our distribution. We're still trying to extend our product base, which you saw with LMAX Digital. So the curves are currently up, but let's see how long this drags on for and whether we need to adjust our focus. But certainly, I think the big growth areas for us are going to be around things like market data, and that doesn't go away. I mean, as I said to you before, at LMAX Group, you've got one of only 3 sources of firm liquidity on the street. As our volumes become more relevant, everyone needs to have that in their stack. So I think market data will become an increasingly important factor for the LMAX Group.
But then what about actually doing the actual work behind this product development going forward? I mean, is that impacting? I mean, you mentioned you got developers in Auckland, and, you know, 140 offices or whatever, but it strikes me there must be some sort of impact around that.
Yeah, again, I'd have to say yes. There's bound to be, but so far so good. I mean, look, we're 6 weeks in. We're quite fortunate. You know, we're a fintech company. We rewrite a third of our code every year. The guys work in pairs, so they're not always in one big group. We've done our first virtual pairing. So literally, what is pairing? You know, one guy writes the code, one guy reviews it, or one guy writes the test. So we did our first virtual pairing last week, and that seems to be working well. The hard bit will be new staff, new brains, because we don't have big specs here, right? It's not waterfall technology, so you have to pick it up. You have to learn from the guys you code with. So I've got a couple of new developers who literally have never been in the office, or they've been in once to pick up a laptop. So you'd expect productivity to slow a little bit, but so far, look, at the end of April, we're on track, as much as you're ever on track in software development, for where we thought we'd be at the start of the year. If this went on until the end of the year, well, yeah, I guess you could probably say I'd estimate a 20% downturn in productivity. Maybe I just have to employ more people remotely for that. But let's see. And I'm very proud of how we've managed to cope. I'm very proud of how the technology team have worked. I'm most proud of the fact that how robust 5 exchanges have been over the last 6 weeks. And I must say, look, as an industry, we should be proud of how we withstood this. You know, back in the early days, people were saying, you know, are they going to close FX? Well, it's impossible. But are they going to shorten sessions in equity? So as an industry, we've done well. And certainly from an LMAX perspective, I'm very pleased with how things have been maintained and even grown over the past couple of months.
It's a good note on which to end. We do like a good upbeat, positive ending. Yeah. Yeah, I mean, it's interesting times, and I think I take on board your point there around sort of that importance of being able to embrace new employees and actually imbue the culture of the firm in them. That becomes a challenge. But David, thanks very much for taking a half hour out of your day. Like everyone, you're pretty busy. Thanks everyone for the hundreds of you that are tuned in still. We'll be back for our next session at the top of the hour. The chat function is open. Knock yourselves out. Thanks a lot.
Thanks, Colin.